John Teixeira, Trevor Kerr here with today's Mortgage Minute. Our topic today is going to be financing rental properties. Alright, so Trevor, the first thing, probably the thing that people wonder most is how much money is it going to take for me if I want to buy a rental property?
That's a pretty easy question, John. Used to be it was hands down, you had to put 20% down. Now we've actually opened up where we do let people buy investment properties with a minimum of 15% down. However, if they do 15, they are going to have a mortgage insurance premium that's going to last till they hit that 20% equity.
Okay, so I'd say the average investor buy and hold properties between $150,000 to $200,000. So let's say if we got a $175,000 house, we're looking at roughly $35,000 without paying the mortgage interest?
That's correct.
Okay. And 15% would be, I don't know, what, 25,000, I'm trying to do math in front of the camera. But
20, right at about 25 grand.
About 25 grand, okay. So what else can we expect? What else can a home buyer or new investor expect when they come to closing? I know there's more than just a down payment that they're going to have to pay for.
They're going to be looking at having their down payment and their closing costs and their prepaids, John. So most investors that are buying a house and putting 20% down choose to handle their own escrow account, so it alleviates a little bit of the cost up front. But in that same price range, you're talking about $150,000 to $200,000. You're going to be talking an extra anywhere from $4 to $6 grand, whether you have an escrow account or not.
Yeah, and as a property manager, we always recommend to our investors that they escrow anytime they can. It's just one less thing you have to worry about. You don't want a tax payment or insurance payment or something to be forgotten about. So it gives me some peace of mind to know that that's escrowed into the mortgage payment when investors, especially new investors that are buying. So one of the other things that a lot of people probably wonder about is, how do I qualify for? I have a mortgage right now. I have a job, I make so much money, and I have a mortgage for the home I live in. How on earth am I going to qualify for another home?
The great thing about investment properties and stuff, as long as you're qualifying, make enough income to qualify for your own house, your car payments, anything else that show up on a credit report, we don't have to worry about qualifying for two houses, because at that point in time, we're going to give you credit for the future rental income that you're going to be deriving off this property.
So in most cases, what we find in the market right now is we buy that $175,000 house, let's say. Give me, if I put 20% down, what's my rough payment on that? Right off the top of your head.
Roughly your payment's going to be somewhere right around $1,100 or so a month on that property.
That's with taxes and insurance?
With taxes and insurance.
Okay, so and I'm probably going to lease that house for, depending on the neighborhood, $1,500 to $1,700 a month, depending on where it is.
Yeah, so you're going to have a good positive net cash flow on there, which is going to offset that payment.
Right. And so that's the case through most of North Texas, really, is that we find that there's a positive cash flow. You're putting 15-20% down, you're going to have this same scenario that Trevor and I just talked about. So it's probably pretty rare that you find that qualifying condition is a problem nowadays, right?
Most of the time, like I said, 99% of the time you're looking at buying an investment property, chances are you already qualify for your current debts that you have. So qualifying for an investment property is not going to be an issue. It mainly comes down to, you have the down payment to be able to purchase it.
Trevor, people think that this is so hard to do, and you're just making it sound so easy. Is it really that easy? You just got to have some money, right?
It's that easy. You just got to have the money and find the right realtor to find you the house, and that's why you're here.
So Trevor, the other way people get into investing is, I have a lot of buyers who come to me and they say, hey, we want to move up and we're thinking about either selling or renting our house. What do you think? And I always talk to them about the benefits of keeping their house and using it as an asset to help their family build wealth. So talk to us about what that buyer that's moving up into a bigger home and thinking about keeping their old home as a rental property. Tell us about that, because I know it's a little bit different, isn't it?
It is. It's a great way to get started, especially if you have an investor just starting out and, a young investor or something that's buying their first primary residence. A lot of investors will go buy their primary residence, then move up and continue doing that. The big advantages of doing it that way is the down payment is cheaper because they can put down 3.5% to 5% down on their primary residence. Now, when they go to move up, there are some rules that get a little bit tricky at that point in time. When you go to move up, to be able to count that rental income off your old house that you lived in, moving up to the next one, you're going to have anywhere from 25 to 30% equity in that home to be able to count that rental income when you're looking to buy your next home.
Okay, so what that person needs to do, hopefully they've already called me, right? And hopefully they already know what they can sell that home for, and if they don't, they need to do that. That's really important for this person. But also calling you to go through that process of pre-qualifying and make sure that that's something they can do before they just head into that game plan, right?
That's definitely correct, because at that point in time, there are a couple exceptions. If it's a VA buyer, at that point in time, they don't have to have the equity position. So each different loan program and different scenario is a little bit different, but a general rule of thumb, they're going to need 25 to 30%.
Well, that's awesome, Trevor. You made this sound really easy. Like, why doesn't everybody do this?
Everybody should be doing it.
Everybody should be doing it. It's the best way to build wealth for your family. And you know what? As a property manager, also, we manage a lot of properties here in North Texas, and we just watch people build wealth over and over and over again. And sometimes they end up selling and reaping the reward of that wealth building, and sometimes they just hang on to it for decades and they really reap the reward. But it doesn't matter how long you do it. A buy and hold strategy is a great way to build wealth for your family, and Trevor Kerr is a great person to go to for financing. There's no reason, is there, Trevor, to pay cash for a house and put all your money into a house. You don't need to do that to build wealth, do you?
No, absolutely not. Especially the interest rates that are out there and the tax benefits.
Still crazy
and stuff.
low.
Yep.
Yeah. All right. Well, I hope that's been helpful. I hope you guys have some ideas on how easy it is to finance rental properties. I hope we've inspired you to maybe think about buying your first rental property. Call me. Obviously, I'd love to help you if you're thinking about buying your first rental property. Call Trevor for financing. And thanks for watching the Mortgage Minute.